Have you ever wondered what ETF and REIT are and how they differ? Well, you're not alone. We're embarking on a journey to unmask these financial acronyms that often leave many scratching their heads. ETF, or exchange-traded fund, is a type of investment fund and exchange-traded product traded on stock exchanges. ETFs hold assets such as stocks, commodities, or bonds and generally aim to track the performance of a specific index. On the other hand, we have REITs, real estate investment trusts, that are companies owning and often operating real estate that generate income. They're a way for individuals to invest in large-scale income-producing real estate. Both ETFs and REITs have their unique characteristics and can be powerful tools in your financial arsenal. But how exactly do they differ? What are their pros and cons? And most importantly, which one is right for you? These are the questions we'll be tackling. So, buckle up as we dive into the world of ETFs and REITs. First up, let's demystify ETFs. ETFs, or exchange-traded funds, are a staple in the financial world. Picture them as a basket of securities you can buy or sell through a brokerage firm on a stock exchange. ETFs are unique because they track an index, a commodity, bonds, or a basket of assets like an index fund. Think of it this way. Instead of buying individual apples, oranges, and bananas, you're buying a fruit salad that's got a bit of everything. This way you get to enjoy a variety of fruits without the hassle of buying each one separately. That's the essence of an ETF. You're not just investing in one company, but a collection of different ones. Now, how do ETFs work? Well, they're quite straightforward. ETFs are managed by professional fund managers. These experts aim to ensure the ETF's performance aligns with the index or asset it's tracking. So if the index goes up, your ETF should too. And if it goes down, well, you get the picture. The beauty of ETFs lies in their diversity and flexibility. They offer a wide range of investment options. Whether you're interested in technology, healthcare, or even the entire stock market, there's likely an ETF for that. Plus, they're traded like individual stocks. This means you can buy and sell ETFs throughout the trading day at fluctuating prices, unlike mutual funds which only trade once a day after the market closes. But remember, with great potential comes great risk. ETFs are subject to market risk, which means their value can go down as well as up. And just like our fruit salad analogy, if one fruit goes bad, it could affect the taste of the whole salad. So, it's crucial to understand that while ETFs can provide diversity, they can't entirely eliminate risk. Now that you've got a handle on ETFs, it's time to switch gears and explore REITs. Scene script. Ready to get a grip on REITs? Here we go. Imagine for a moment that you're a real estate mogul. You own properties far and wide, and each month you're cashing in on those rent checks. Sounds dreamy, right? But there's a catch. You also have to deal with tenant issues, property maintenance, and all the other headaches that come with being a landlord. Enter real estate investment trusts, or REITs. REITs let you invest in real estate without having to own a physical property. Think of it as a mutual fund for real estate. At its core, a REIT is a company that owns, operates, or finances income-generating real estate. These companies pool together money from numerous investors to purchase a portfolio of properties which can include everything from shopping malls and office buildings to hotels and apartment complexes. The way REITs work is pretty straightforward. After collecting rent from their properties, they distribute the majority of that income, typically at least 90%, back to investors as dividends. This way, you as an investor get a slice of the real estate earnings pie without having to deal with the day-to-day hassles of property management. Now, let's talk about the upsides and possible downsides. On the plus side, REITs offer a way to diversify your investment portfolio beyond traditional stocks and bonds. They also provide a steady stream of income through dividends, which can be particularly appealing to retirees or others seeking regular income. But like any investment, REITs come with risks. One major risk is that the value of real estate can fluctuate, which can impact the value of your REIT investment. Additionally, because REITs are required to distribute most of their income as dividends, they may have less cash on hand for property improvements or acquisitions. So, that's REITs for you, but how do ETFs and REITs differ? Let's find out. Scene script ETFs and REITs may seem similar, but they're not. Here's why. Exchange-traded funds, or ETFs, and real estate investment trusts, or REITs, both provide a way for investors to diversify their portfolios. But their approach to investment, the level of risk involved, and the potential returns can vary greatly. Let's start with investment strategy. ETFs are essentially baskets of securities like stocks or bonds that are traded on an exchange. They often aim to replicate the performance of a specific index, whether it's focused on a particular sector, country, or asset class. This means that when you invest in an ETF, you're essentially investing in a wide range of companies or assets at once. On the other hand, REITs are companies that own, operate, or finance income-generating real estate. When you invest in a REIT, you're essentially buying a share of the real estate that the REIT owns. This can be anything from office buildings and apartments to hospitals and shopping centers. Now let's talk about risk. Generally speaking, ETFs are considered less risky than individual stocks because they provide diversification. If one company in the ETF performs poorly, it's balanced out by the others. However, the risk level of an ETF can vary depending on what it's tracking. REITs, on the other hand, are subject to the ups and downs of the real estate market. They can offer high returns when the market is booming, but they can also suffer significant losses during downturns. Finally, let's consider potential returns. ETFs typically aim to match the returns of the index they're tracking. So if the index goes up by 5%, the ETF should too. REITs, however, generate income through rent and property sales, and they're required by law to distribute at least 90% of that income to shareholders. This can result in high dividend yields, making REITs an attractive option for income-focused investors. As you can see, ETFs and REITs cater to different investment goals. But which one should you choose? Let's discuss. ETF or REIT? That's the million-dollar question, but before you start flipping coins, let's dive a little deeper. Choosing between exchange-traded funds and real estate investment trusts depends largely on your individual investment goals, risk tolerance, and the current market conditions. Let's talk goals first. If you're looking to diversify your portfolio and spread out risk, ETFs might be the way to go. They allow you to invest in a wide variety of sectors and companies within a single fund. You're not putting all your eggs in one basket, so to speak. On the other hand, if real estate is your passion and you want to invest specifically in this sector, REITs are a great option. They offer a direct route to property investments without the hassle of owning and managing the property yourself. It's like being a landlord, but without the late-night plumbing emergencies. Next, let's consider risk tolerance. ETFs generally provide a lower risk investment than REITs. They're spread across multiple sectors, which can help cushion the blow if one industry takes a hit. REITs, however, are subject to the volatility of the real estate market. If the property market declines, your investment is likely to follow suit. But what about the market conditions? Well, if the stock market is booming and companies are thriving, an ETF could provide substantial returns. However, in a sluggish economy, the stability of rental income from a REIT might be more appealing. Ultimately, the choice between ETFs and REITs comes down to a balance between your financial goals, your appetite for risk, and the economic climate. It's about understanding your own investment style and finding the right fit for you. Remember, there's no one-size-fits-all answer. Your choice depends on your personal financial situation and goals. So there you have it, ETF and REIT 101 in under 10 minutes. This journey has been like navigating through the financial alphabet soup, hasn't it? But remember, these aren't just letters. They are opportunities. Opportunities to diversify your portfolio, to generate passive income, and to leverage the growth potential of the stock market and real estate sector. ETFs and REITs are different, yes, but they both offer unique benefits for investors. ETFs provide broad market exposure and flexibility, while REITs allow you to invest in real estate without the hassle of owning physical properties. They're both tools in your financial toolbox, ready to be used depending on your goals and risk tolerance. Knowledge, as they say, is power. Don't stop at this 10-minute video. Dig deeper, learn more. Equip yourself with the financial literacy you need to make informed decisions. And that's a wrap. If you found this video helpful, please hit the like button, share it with your friends, and don't forget to subscribe for more financial insights. Until next time, happy investing.